the context of this video is just to teach the principle of allowing your money to compound and paying simple interest in the process to help you create leverage and wealth, right? So let's take a look at this. You got $10,000 right here in your account. That means your collateral capacity. Now, what is collateral capacity? That means you are never borrowing from your policy. We are always utilizing our policy when we utilize whole life insurance as collateral to get a guaranteed loan from the insurance company or to get a cash value line of credit assigned to the value of our loan to be able to leverage that money. Now, there's always a cost of borrowing, and so that has to come into consideration here. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, we're gonna be talking about simple interest versus compound interest, and ultimately the power that whole life insurance gives you to be able to earn compounding interest while paying simple interest, and ultimately how it works. Now, just for full transparency, I've put together a little spreadsheet just to kind of show everybody how this works. This is not designed to be any kind of indication of an illustration. It's just to push across a principle, to teach the concept, and to really break down how something that's fairly complicated, try to break it down into its simplest terms for you to understand. Now, if you have any questions about this as we go through, I've got a lot of other videos on these types of topics, so make sure you subscribe, hit the bell, go check out our playlists. Lots of content on these financial topics. Now, when it comes to what I want to cover today, I'm going to actually go over, I'm going to share my spreadsheet, my Google Sheet that I created, and I want to go through it and just, I think as I do, it'll start to make more sense and we'll have more of a conversation here. All right, so here we go. So let's take a look at this spreadsheet. You could see year one. Let's just say we have a $10,000 cash value. Now, this is not necessarily the premium you put into the policy. In year one, you may need to put $11,000 or $12,000 in, depending on how you have the policy designed, to have a net cash value and liquidity of about 10,000 bucks. This is just to teach the concept. Now, there's a lot more detail and there's a lot more nuance, and this is where life insurance is an asset, and utilizing whole life insurance as the asset to get into real estate, to buy crypto, to do day trading, to a lot of other things, right? Like any of that. This is where the power lies, and in order to really execute, this video is not going to get you everything you need to know. So just know that I'm not trying to teach you everything in this video, because I know every time I do a video like this, I feel like people bang on me and they're like, you didn't talk about this or that. And I'm like, wow, that was not the point of this video at all. So I got other videos for that. But so the context of this video is just to teach the principle of allowing your money to compound and paying simple interest in the process to help you create leverage and wealth, right? So let's take a look at this. You got $10,000 right here in your account. That means your collateral capacity. Now, what is collateral capacity? That means you are never borrowing from your policy. We are always utilizing our policy when we utilize whole life insurance as collateral to get a guaranteed loan from the insurance company or to get a cash value line of credit assigned to the value of our loan to be able to leverage that money. Now, there's always a cost of borrowing, and so that has to come into consideration here. So what we have here is a collateral capacity, meaning that's how much leverage we have of $10,000. Simple interest. So we're going to take a loan with simple interest because that's what the insurance company does. They say, okay, $10,000 is what you are paying, and is what you're taking out for loan. You are going to pay 5% on that year. So if you hold this loan, so you basically are paying simple interest of 5%. So if you held the loan for a year, at the end of the 12 months, you're going to get a interest payment, or a bill for interest for 500 bucks. Now, you can handle this as an interest-only loan, which is what I'm going to do in this scenario to keep it simple. By the way, this is not what I would suggest to do if you were to utilize a policy like this, because this is not the max efficient way to handle this. However, it is what I'm doing to teach this principle and this concept, because you have to understand this part of this before you can get to the next level. So we got to do it step by step by step here. So you got the $500 in interest, but here's the deal. Because you're not borrowing from your money, you're borrowing against it. That means this $10,000 is growing. So let's say it's growing at 5%. Because a lot of people would say, well, if I'm paying 5% and I earn 5%, why would I even want to borrow? I would just pay cash, right? That's the idea. And here's where you're going to learn, because what happens, and this is really a big part of the power of utilizing whole life insurance as an asset, is the fact that now what do we have? We have a total interest expense in column G here of $500 and a total account growth of $500. So we cut a check for $500 and we pick up an interest expense for this simple interest loan. So this is where people who don't like whole life insurance go, well, why am I going to pay to borrow my own money? Once again, you're not borrowing your own money, you're borrowing against your money. You're leveraging your money. So when you pay $500 in this scenario, what happens is the next year you go over to year 2, the next year you start off, your account value is $10,500 because it earned 5%, right? Now, once again, in real life, this would actually be higher because you're going to contribute. You're going to have premium payments into your policy that are going to make it higher. But once again, I'm just trying to focus on this one myopic $10,000 deposit and leveraging this one component of a transaction inside of the greater policy, right? And so that's the purpose of this. Now, what is your collateral capacity in this scenario? It's $500 because you've already got a loan against your policy for $500. Okay, so it's important to understand that. So you've got this $10,000 and it's out there, and you're borrowing against it. So what happens is you still have that $10,000 out there. You have $500 that you could borrow more from if you wanted to, more against that if you wanted to, because your account grew by that amount. Now, you still have to pay another $500. That is your cost for this $10,000 loan. So you can see that's the case. Now, here's where it gets cool. You earn 5% on the $10,500 because this is compounding. Your cash value inside of your policy is compounding at 5%. So you pay the 5% simple interest every year. Meanwhile, because this money never stopped working for you, it's now earning 5% on a bigger number. This is the power of infinite banking. This is the power of utilizing whole life insurance as an asset. Now, it's also one of the most oversold things. And I've got other videos on this because it's really, like I said, this is not meant to say this is the end all be all. This is the way it works inside of a policy. However, you need to understand this concept on how it works once again. So now you can see in this scenario, you got $525 of interest, right? And the total interest expense is $1,000 because it's 500 and 500. And then the total account growth is now 1,025 because you earned 500 the first year, which is a break even, and then 525 the second year. So now you're ahead by about 25 bucks. And this just continues. So the next year you got 11,025. Your collateral capacity is 1,025. That means you have the loan and you've paid the loan, but all the interest. So this is one of the things that I can't stand is everybody saying that you pay yourself interest, because you don't pay yourself interest. You can never earn interest because these $500 payments are going back towards the insurance company. These loan payments are going to the insurance company. They're not going to you. So it's important to understand that. However, at the same time, your account continues to grow, right? So, and this money here, this 1,025 is more than the $1,000 of interest that you've paid into it. So if you can do that, that's leverage. That's a system that you can run money through to create wealth with less effort. It's getting your dollars to perform more than one function for you. And that is the power of utilizing this system. So now you can see, once again, you've paid a total interest of $1,500, but you've earned $1,576. Now, I'm not going to go through this year by year by year. If you want to, I'm going to zoom this in for you. You can pause it and you can take a look at these numbers and you can kind of see what it would look like and just analyze these things. And so pause it right now if you want to take a look at these and really analyze them. And I'm going to skip ahead here. Now, what I'm going to do now is I want to go through, I'm going to zoom back out here so my head's not covering some of this stuff. So what I want to do though is kind of skip ahead. You can see here that because you're paying simple interest, this doesn't compound on you. Now, here's what I want to say. This is where people get in trouble with infinite banking, with whole life insurance in general, and with any life insurance, even IULs, even though IULs carry a lot more danger than this. There's other dangers or risks on top of IULs in addition to what I'm about to tell you. The problem is people say, well, you can earn simple, or you could pay simple interest, but you can earn compounding interest. Well, here's the deal. If I didn't pay this $500, and this is what happens because it's an unstructured loan, if I didn't pay this $500, guess what? It compounds. So now next year, and because it's unstructured, I don't have to pay it. Now the next year I would owe 10,500 and I would be in trouble, right? That would keep growing on the debt side of the equation as well. Now, if you do it 1 year or 2 years, it's not the end of the world. But if you have a practice of not paying back your loans, that's where you can kind of get into trouble. And so you need to make sure that you handle that accordingly. So I think that's really important to understand. You know, the other component here that I would say is when we go down here, we could just look the total interest expense that we have on this without paying down the loan, right? Remember, this is just the principle to show you that the total interest expense is $5,000 and the total account growth is $62.88. So, but here's the power of this. You've picked up that interest and you've spent that interest expense, but here's the deal. I have that $10,000 loan still, but over here, my collateral capacity, meaning I could borrow against another $5,500. So I have access to this capital if I need it for more leverage. And this is what we call the velocity of money. We're able to get our dollars to do more than one things, get them into circulation. The money that we're putting back into the policy is allowing our policy to grow and be efficient. If we didn't pay these loans, that money would not be available, right? And so it's really important to understand that over these years, just alone, our account has grown by more than we paid, and we have actually an extra $500 in collateral capacity. We still have a loan out on this, but we have an extra $500 compared to what we paid, because 10 times 500 is 5,000, and you can see here we have $5,513 in collateral capacity that we could take a loan against after 10 years. So when you break it down, that is the power of infinite banking. That is the power of utilizing whole life insurance as an asset. And once again, I know it's a complicated conversation or topic, and it's one of the most confusing things that shouldn't be more confusing, or I guess people make it more confusing than it needs to be. So what I would encourage you to do, if you haven't already, make sure you subscribe, make sure you click that bell, that way you get notified every single time I launch a new video. I do have a playlist for infinite banking that I believe simplifies, and I talk about infinite banking in a way that simplifies it like nobody else does. That's what I really try to focus on with all this stuff. So if you have any questions at all, go ahead and comment in the comment section below. I engage with every single comment that I see. I really take pride, and I have a lot of passion for making sure I do that with people. And I guess aside from that, if you have any questions at all, reach out, send me an email, chris@life180, and that's it. Until next video, have a blessed, inspirational day. We'll talk soon. See ya.